Hello, folks. Brandon Chapman today for the Theo Night video for Monday, September 27th, 2021. As we look at the market today, really, it was a pause, right? We're just kind of hanging in there after a really nice rally to end last week. But really, when you start to look at the ES futures, we're talking about really Friday and today. We're really just sitting in a range for all intents and purposes. Of course, the ES futures incorporate the overnight trade as well. As you kind of circle your attention back to the SPY as it's trading during the cash open and close, you'll notice that today's range is very, very tight, opening and closing almost at the exact price, same price today for the SPY. Also, some things you may notice by virtue of my notes here is that, look, there's been a lot of activity between 443 and 444.50, and this was highly unusual. I've been tracking it the last week, well, actually a couple weeks ago, before the sell-off, but you'll see here 2.3 million shares, 444.43, 1 million at 444, 1.75 million at 442.86. And during my session, we kind of drew some lines that said, hey, if we close below that, we're going to head lower. And that's exactly what happened as we tested the, down here below 434 on the SPY or 43.40. The point being is we're rallying back up to these exact same levels. And right now, we're seeing the pause. Now, is it the pause that refreshes to the upside, or is the pause that refreshes to the downside? As you look at last Thursday's trading range, it may help provide those levels that if we close above or close below, may either lead to further strength or further weakness. But again, we're getting these key levels here. As you look at the Qs, for example, or the Nasdaq futures, whatever you want, again, you'll notice that tech was weak today. Didn't really support the broader market. And again, that's a problem. What are we resting on? As you look at the top performing sectors today, it was energy, financials, materials, but really energy was leading away. One that we've been watching for a while is like MRO, for example, getting very, very close to the target we set a little while ago. Also, as you look at other energy names, they've done really, really well in light of the fact that, guess what? Oil is marching higher. And in today, we did close above the 75 level. Now, we're not exactly taking out prior highs, but again, forecast raising for maybe a $90 handle on oil as production cuts are happening. So again, we'll see how this plays out, but the oil market has remained strong. But the problem is, given how much energy stocks have declined, if we look at XLE as an example, they've really diminished in their impact on the broader market as a result of their prices coming down. So likely the market cannot be carried by energy and financials. It's interesting, right? As we look at financials here, XLF, we're really rocketing higher. And this is kind of setting up the possibility for this debt ceiling trade. So for example, the first issue where we might start with a government shutdown or partial shutdown this week is September 30th. The Treasury is running out of money. They've got to start to raise more debt. The only way to kind of in the near term protect against that is by what? Just shutting the government down, using that money they would otherwise pay to cover their debt obligations. Now, again, don't think that a default is likely in the cards. If we're looking at, for example, IRX, 3-month T-bills would be exploding, and they're not. You could go back to the debt ceiling that we had in 2011. We saw a decent little sell-off in 3-month T-bills. But again, even at that, it only hit 1, which is 0.1%. So again, there's not really a possibility or really pricing in the event of default. But it doesn't mean that there aren't concerns out there. And there is the possibility that the debt ceiling deal does get done, and the possibility that maybe they do raise it, that $3 or $4 trillion that would probably support a continued debt going into the next year. Because we're in the age of perpetual $3 trillion deficits. Don't mistake that out. And as you look at, for example, the TNX today, the 10-year Treasury yields have been really popping here over the last 3 days. Again, there's been some significant activity in TLT bearishly. In fact, our last Wednesday's at the close for our members, Don and I discussed this, a huge activity in TLT to the downside. That also happened on Friday as well as it continued lower. And now we're getting these lows again. This does place pressure on stocks. It does weigh on valuations for technology names. Again, as a discount mechanism for future earnings, bringing it back to the present, it means that present price is not worth quite as much as the discount rate goes up. Now, to kind of turn to how the market's positioning themselves, there was a number of significant option activity trades today. And obviously, if we raise the debt ceiling, as the Fed is continuing to continue their purchases and the like, it doesn't bode well for the dollar. And yet the dollar was up today, although minimally. Not that this is a hugely volatile product. But if you go to the trade tab here, you look at the option chain for this week, 13,000 puts mostly bought at the 25 strike. What is that indicating? At least some are thinking, hey, we may have a chance of rolling back here. In the next week, we hit 24.70? Absolutely. What that does mean, the dollar would have to be selling off vis-a-vis the euro predominantly. But there's also the potential for some of the emerging markets. The Aussie yen, Aussie dollar is a pretty good representation of this. If this starts to move higher, that's generally supportive for emerging markets and currencies. As we look at the emerging market ETF, EEM, again, a large weighting to Chinese companies as well. But if we notice in today's trade, EEM was actually a November expiration. So November expiration here. 44,000 contracts. In fact, 44,000 traded in one print, meaning one trade at that $53 strike. So again, some money being plunked down with the expectation likely that the dollar falters and that emerging markets that have not performed quite as well may see a little resurgence here. Could we push towards 54 in the near term? That may be a possibility. Could we recoup our prior highs? Probably not, unless we see a broader market rally and we don't see any broader spillover in terms of weakness. The next thing to worry about is what? HYG. The fact that we're seeing rising treasury yields generally means that HYG or high yield or junk bonds should be a better place to go. And that's exactly what it's done. The only problem is if treasury yields continue higher, the risk-free rate, it's compressing the spreads between junk bonds and treasuries, and it may create pressure eventually on HYG. If the market succumbs to the pressure of rising yields and we see a major sell-off in the markets, that generally causes HYG to go down. It seems like it's sitting in a very good position that if there's a major move up in yields or a significant move lower in stocks, it's probably going to do relatively well. And with today's trade, it was a 5 November expiration on this one. And again, it was down here, 15,000 contracts bought at the 86, 20,000 sold at the 82. Again, pointing to some downside. Now, there's a ratio here. We're not necessarily expecting to get it below 82 in that trade specifically, but it was significant and it is bearish. And $82, frankly, it's quite a ways off. And knowing the fact the Fed is kind of withdrawn a little bit from this market, it doesn't have any current holdings. A lot of the thesis of why HYG or junk bonds should hold up is kind of faltering here. And somebody's taking a very rather large downside shot to about $82, which happens to be last fall's lows. Also corresponding with this trade, as yields are rising, as you look at the TNX, for example, generally that favors banks if the yield curve is steepening. And that's generally what's happening. Banks borrow for virtually nothing and they lend out at higher rates. There's also the potential as the Fed tapers from mortgage bond purchases. There might be more money to be had in the mortgage market because the mortgage rates are going to go up. Point being is that lending rates are probably going to rise, which generally benefits banks. And as you look at JP Morgan over this 3-day sell-off, it's done rather well. And in fact, even today on the weekly, so again, very short-term oriented, sometimes this stuff gets faded, but it didn't today. 13,000 contracts, mostly bought at the 167.50. And again, pointing to that lift that we're seeing. And it wasn't just JP Morgan. It was also Bank of America. As you look in here as well, Bank of America was the 1.43. I mean, it's kind of spread around here, but the 1.43 early on was that area. And it spilled out into higher strike prices. Again, closing, as we look at here, closing near the high of the session. We may see continued momentum here. Now, again, financials, if the broader market sells off, you'd probably guess they're going to come down. Right now, they're helping support things from a sell-off. So as the market continues to consolidate here, if that were to happen, there is maybe a little bit of upside, but there's probably an opportunity also to fade some of this very significant bullish interest. And I'll tell you, it's not been bullish for all banks. Wells Fargo was a company that last week during the Fed statement, it was very obvious that, in the Q&A session, that, there was some uncertainty about some regulatory issues with regards to Wells Fargo. That kind of came to the fore today, creating some initial weakness. It was a little rally off those lows again. But this is an interesting one to watch, that Wells Fargo could see itself deviate from the broader financial space or stock space. Also, we're going to wrap it up, CCJ. Why not, right? Let's make this explosive. We're talking about uranium. Uranium was up 4.38% today. And an interesting set of trades placed for the November expiration here. And again, as you look here, you'll see, significant size with only the 28 strike being the volume where it's just marginally above the open interest. So it's pretty close there, meaning this could be closing interest where the other is open. And once you start to look down here at the option time and sales, rather, what you'll see is that, it gives you a sense of what's going on. In this case, for example, the 28 strike that had all that open interest is getting rolled down to the 23. And then you look at the 25 and 30 strikes here, 8,200 contracts. That's a long call vertical, buying the 25, selling the 30. So it gives you kind of a sense here of where they're expecting CCJ to go. We're talking about 30. This just got rolled down to the 23, so it could be more connected with the price, have a higher delta if there's a rally here. Now, certainly, this is a company that does not have great earnings trends. Certainly, their biggest area, their biggest mine for uranium production, the Cigar Lake, is out of commission for the time being. They're looking to automate it. Nonetheless, it's a play that has been relatively popular, kind of becoming meme-ish. But again, is this an indication? Maybe we're starting to see a little bit of resurgence here. Now, could we go to 30 by November? Could be pie in the sky, but we could see a pretty reasonable retracement off of these levels here. So even taking like a fib retracement from the high down to the low, could we see a 1/3 to 22.50? Yeah, 2/3, maybe $24. That's probably what you'd be targeting, somewhere in this range if you get this. Even a simple like in-out spread, buying a 20 and selling a 22 does not require a lot of movement for that November expiration, and it's pricing at less than $1 here. So again, the pricing is relatively favorable for doing long call verticals if that's what you're trying to do with defined risk. Well, folks, that's all we got for today's video. We'll see you back tomorrow for another video. I'll be back on next week, and we have a great one. This is our 3-night video for September 27th, 2021. Thank you.